The IRS senior deduction can be worth up to $6,000 per eligible person, but 5 filing mistakes can reduce it, delay it, or make you ineligible. For retirement tax planning in 2026, the biggest mistake is assuming that everyone age 65 or older automatically gets the full $6,000 senior deduction. They do not. President Trump signed the law that created this enhanced senior deduction, and the IRS now uses Schedule 1A to calculate and claim it. If both spouses qualify and file jointly, the maximum can be $12,000. But age, filing status, social security numbers, modified adjusted gross income, and the actual tax form all matter. In the next few minutes, I will show you the 5 mistakes in the order I would check them before a senior files a return. Then, I will give you a 1-page mental checklist you can use with tax software or a tax preparer. Let's start with the mistake that can wipe out the deduction before income is even calculated. Mistake number 5, assuming I turn 65 soon is the same as being 65 for the tax year. The enhanced senior deduction has an age test. For the tax year you are claiming it, the IRS says you must be age 65 on or before the last day of that tax year. That sounds simple, but timing matters. Suppose Susan turns 65 on January 10th of the following year. She may feel like she is basically 65 when she files, but she did not meet the age test by the end of the prior tax year. So, she cannot claim the enhanced senior deduction for that prior year, merely because she is 65 by filing season. The first thing to check is not your age today. Check your age on December 31st of the tax year you are filing. For a married couple, check each spouse separately. One spouse may qualify while the other does not. That means the couple might qualify for $6,000 rather than $12,000. Do not jump from "we are retired" to "we get $12,000." The deduction is age-based, not retirement status-based. Mistake number 4. Using the wrong filing status when you are married. This rule can surprise people. The IRS says that if you are married, you must file a joint return to claim the enhanced senior deduction. Married filing separately does not qualify. So imagine John and Maria are both 68. They meet the age requirement. They both have valid social security numbers, but they decide to file married filing separately because they have used that status before. For this enhanced senior deduction, that filing status choice matters. They cannot simply claim $6,000 on each separate return. Before a married couple assumes they qualify, the filing status question has to be settled. This is especially important if the couple is considering filing separately for another tax reason. The right question for the preparer is, if we file separately, what deductions or credits do we lose, including the enhanced senior deduction? That one question can prevent a very expensive assumption. Now here is the first action step. Before you calculate any dollar amount, write down 3 items: age at year-end, marital status, planned filing status. If those 3 do not line up with the rule, stop there and fix the eligibility question before doing the rest of the math. Mistake number 3. Treating the $6,000 as automatic and ignoring the income phase-out. This is where the word "up to" matters. The maximum enhanced senior deduction is $6,000 per eligible person, but the deduction begins to phase out when modified adjusted gross income exceeds $75,000 for an individual and $150,000 for married couples filing jointly. The IRS processing guidance says the deduction is reduced by 6% of the amount above the applicable threshold. Take a simple hypothetical. Robert is single, age 68, and otherwise eligible. His modified adjusted gross income is $100,000. That is $25,000 above the $75,000 threshold. 6% of $25,000 is $1,500. Start with the $6,000 maximum. Subtract $1,500. Robert's enhanced senior deduction would be about $4,500, assuming the rest of the return supports that result. Now, Take a married couple where both spouses qualify. Their maximum is $12,000. Their modified adjusted gross income is $200,000. That is $50,000 above the $150,000 joint threshold. 6% of $50,000 is $3,000. Their potential enhanced senior deduction would be about $9,000. The point is not to memorize those examples. The point is to stop thinking of this as a flat benefit. For retirement tax planning, the income number can change the deduction materially. And this is one reason a large IRA withdrawal, Roth conversion, capital gain, pension distribution, or other income event can matter. The senior deduction is not calculated in isolation from the rest of the return. So, before year-end, retirees with flexible income should understand whether a planned transaction pushes modified adjusted gross income farther into the phase-out range. This is not a reason to avoid a transaction automatically. It is a reason to calculate the full tax effect before acting. So far, 3 mistakes can change the answer before you ever reach the final tax bill. Wrong age assumption, wrong filing status, wrong income assumption. The next 2 mistakes are more procedural, but they are just as important because they affect whether the IRS can process the deduction correctly. Mistake number 2, ignoring the Social Security number requirement. The qualifying senior must have a valid Social Security number for purposes of the deduction. For the current IRS instructions, that number must satisfy the timing and validity requirements described for the return. If both spouses are claiming the enhanced senior deduction on a joint return, each spouse claiming it needs to satisfy the SSN requirement. This does not mean you should read your Social Security number aloud to anyone who calls you. Do not do that. A legitimate tax return needs identifying information. A random caller claiming to activate your senior deduction does not. The new deduction creates a perfect setup for scams because the words $6,000 for seniors sound like a payment program. It is not a payment program. There is no special government agent who needs your bank login to unlock the deduction. There is no activation fee. There is no need to send a Social Security number by text message to someone who contacts you unexpectedly. Use irs.gov, your tax software, or a trusted tax professional. That is the safe path. Mistake number 1, assuming the old standard deduction automatically includes the new senior deduction. This is the procedural mistake I would watch most closely. The enhanced senior deduction is separate from the existing additional standard deduction for people age 65 or older. The IRS created Schedule 1A for the new deductions enacted under the law. The senior deduction is calculated in Part V of Schedule 1A. The total additional deductions then flow to Form 1040. That means you should not look at the ordinary standard deduction amount and assume the new $6,000 is already buried inside it. It is a separate deduction, and eligible taxpayers can claim it whether they use the standard deduction or itemize. That last point is important. Some retirees hear the word deduction and assume I itemize, so this senior deduction does not apply to me. That is incorrect. The IRS says eligible itemizers can also claim it. For the 2025 return filed during the 2026 filing season, Schedule 1A is the key form used to claim the enhanced senior deduction. IRS processing guidance shows that failing to complete or attach Schedule 1A can result in an adjustment notice. Tax software may handle the form automatically after you answer the age and income questions, but do not assume that automatic means invisible. Review the return before filing. Look for the Schedule 1A calculation. Ask where the enhanced senior deduction appears, and make sure the amount matches your eligibility and income. The 5-step IRS senior deduction check. Here is the checklist I would use before filing. Step 1. Confirm age at the end of the tax year. Do not use your age on filing day. Use your age on the last day of the tax year. Step 2 WO. Confirm filing status. If married, confirm that you are filing jointly if you plan to claim the enhanced senior deduction. Do not assume married filing separately qualifies. Step 3. Check the SSN requirement. Confirm that every spouse claiming the deduction has the required valid Social Security number. Protect that number from unsolicited callers, texts, and emails. Step 4. Calculate modified adjusted gross income. Do not stop at the $6,000 headline. Check whether modified adjusted gross income is above $75,000 for an individual or $150,000 for a joint return. If it is, calculate the phase-out. Step 5. Verify Schedule 1A. Make sure the enhanced senior deduction is actually being calculated on the correct form. If you use tax software, review the final forms. If you use a preparer, ask them to show you the senior deduction line and explain the amount. Those 5 checks take only a few minutes, but they separate "I heard seniors get $6,000" from "I know exactly what my return is claiming." One more thing about Social Security taxes. The enhanced senior deduction can reduce taxable income. That can lower the final federal income tax bill for many retirees. But do not confuse this deduction with a universal repeal of the rules that determine whether Social Security benefits are taxable. Those are separate calculations. The White House has promoted the new senior deduction as producing a no federal tax result on Social Security benefits for many seniors. But the IRS still has rules that determine how much Social Security may be included in taxable income. So, when you review your return, ask 2 different questions. How much of my Social Security is taxable? And how much does the enhanced senior deduction reduce my final taxable income and tax? Those are not the same question. That distinction is important enough that I am covering it in the next video. The IRS senior deduction is real. President Trump signed the law that created it. And for an eligible person, it can be worth up to $6,000 of additional deduction. But the amount is not automatic. Age can change it. Filing status can eliminate eligibility. Income can phase it down. The SSN requirement matters. And Schedule 1A is how the new deduction is claimed on the return. Before you file, ask one direct question. What exact enhanced senior deduction amount is on my return, and how was it calculated? That question forces the headline to become a number you can verify. Subscribe to Grant Wexford for clear, research-based guidance on retirement taxes, Social Security, Medicare, banking rules, beneficiaries, and senior financial protection. Next, watch. Trump's $6,000 senior deduction. Can you claim this 2026 tax break? That video explains the basic eligibility and income phase-out from the beginning. And in the next video in this tax series, I will show you why no tax on Social Security does not mean the old Social Security tax formula disappeared. This video provides general educational information and is not individualized. Tax, legal, retirement, Social Security, or financial advice. Tax results depend on your filing status, income, deductions, credits, and individual circumstances. Verify current IRS forms and instructions, or consult a qualified tax professional before filing or making tax planning decisions.